Imagine an economy larger than Germany, Japan, and India combined.
Which is a lot of people.
Right. You're probably picturing massive industrial sectors, millions of workers, global supply chains. But today, we're not actually looking at a country.
No, we are diving into Charles Schwab's staggeringly massive Q2 2026 earnings report.
And we have the raw data, the management commentary, and the consolidated financial statements right here.
Yeah, and looking past the dry accounting tables, this report is just a masterclass in modern financial plumbing.
It really is.
It shows us exactly how a massive institution monetizes human behavior on a global scale.
So that is the mission for this deep dive. We are going to break down the mechanics of a $13 trillion financial behemoth. We want to understand what the revenue engine tells us about the broader market, and critically, what retail investors like you are actually doing with your cash right now.
Because the numbers tell a fascinating story.
Exactly. Okay, let's unpack this. We have to start with the sheer gravitational mass of this company because, well, the headline numbers for Q2 are intense. Record net revenues of $7.1 billion.
Wow.
Which is up 21% year over year.
Which, I mean, that is substantial top-line growth for a company of this maturity.
Yeah.
And that translated directly to the bottom line, too.
Right. GAAP earnings per share hit $1.54. That's a 43% jump.
Huge.
Yeah. And their adjusted EPS came in at $1.62.
And, just to quickly clarify that difference for the listener, when we talk about GAAP versus adjusted earnings, the adjusted EPS of $1.62 strips out one-time accounting noises.
Like specific legal fees or restructuring costs?
Exactly. It gives us the raw operating pulse of the business, and that pulse is remarkably strong. But the metric that really demands attention is the total client assets.
Right, the $13.08 trillion.
Yeah. Up 22% year over year. It's a scale that almost breaks our traditional mental models of banking and brokerage.
It does. And what's wild is the velocity of the new money coming in. I mean, despite already holding $13 trillion, their core net new assets for the second quarter hit $119.8 billion.
It's just massive.
It's a 49% growth rate in new asset acquisition compared to the exact same quarter last year.
Which is wild.
Right. Now, generating 49% growth is pretty standard when you're like a scrappy Silicon Valley startup. But generating that kind of percentage growth on a $13 trillion base, it's like trying to double the acceleration of a freight train that is already moving at full speed.
Right.
So how is a legacy giant pulling in core assets at that rate?
Well, it really comes down to the physics of finance. In this industry, scale doesn't just provide stability, it acts as a gravitational pull.
Makes sense.
Yeah. When markets feel complex or uncertain, capital tends to consolidate. It flows toward perceived safety and comprehensive infrastructure. Trust breeds more trust.
So the bigger you are, the more people trust you with their money.
Exactly. And if you look at the management commentary, President and CEO Rick Wurster highlighted that June alone brought in a record $62.7 billion in core assets.
Wait, over $60 billion in a single 30-day window?
Yeah, in 1 month. That translates to an annualized organic growth rate of 5.8%. So this isn't just market appreciation. This isn't just the stock market going up and making their existing accounts look artificially bigger.
Right, this is actual fresh capital.
Fresh capital. Investors opened 1.4 million new brokerage accounts in this quarter alone.
But here is the catch with having $13.08 trillion just sitting there. Storing assets doesn't actually automatically print revenue.
No, it doesn't.
Like if I leave $10,000 uninvested in my brokerage account, it feels dormant to me. I haven't bought a stock. I haven't paid a commission. To the casual observer, Schwab isn't making any money on me.
Right.
But if we look at the revenue breakdown, out of that $7.1 billion in total revenue, only $1.21 billion came from trading.
Right, and trading revenue was up 28%, which is healthy, sure. But what's fascinating here is you're hitting on a fundamental misconception about the modern brokerage model.
That you only pay when you trade.
Exactly. People assume the house makes its real money when you hit the buy or sell button.
But the real heavyweight, the quiet engine driving this entire machine, is net interest revenue. That came in at $3.35 billion.
Yeah, up 19%.
That is nearly triple their trading revenue.
Yeah.
So walk us through how they are weaponizing that idle cash, because this seems to be the core mechanic of their profitability.
It absolutely is. Let's trace the path of that dormant cash you mentioned. Across their millions of clients, Schwab holds what they call transactional sweep cash.
Okay.
At the end of June, that pool of uninvested idle cash sat at $485.7 billion.
$500 billion just sitting there.
Basically. Now, Schwab doesn't just leave that cash sitting in a digital vault. They sweep it into their own interest-earning assets.
Like what?
Well, they might purchase highly secure fixed-income securities, like treasury bonds, or issue safe bank loans.
So they are essentially operating a massive internal bank using our uninvested cash.
That's the exact mechanism. Across the quarter, Schwab had $445 billion in average interest-earning assets deployed. Now, they earn a certain yield on those investments, right? And they pay a small portion of that yield back to the client who actually holds the cash.
Right.
The mathematical difference between what Schwab earns and what they pay out to you is called the net interest margin.
And according to the report, their net interest margin actually expanded by 12 basis points this quarter to hit a clean 3.00%.
Right. Let's look at the exact spread. The average yield Schwab is getting on their deployed assets is 3.96%.
Okay.
Meanwhile, the total funding cost, what it costs them to pay out clients and maintain those deposits, is just 0.96%.
So they yield roughly 4%, pay out roughly 1%, and quietly pocket the 3% difference,
Leaving them with that 3.0% net interest margin. Now, for the listener, 3% might sound like a rounding error.
Yeah, it sounds tiny.
But when you apply a 3% margin to a $445 billion asset base, it just prints money. That spread alone generated $3.35 billion in pure net interest revenue in a single 3-month period.
That is the ultimate proof of why scale matters. But, net interest isn't the only behavioral shift we are seeing in this report. The asset management and administration fees grew 16% to $1.82 billion.
A very solid jump.
Yeah, and looking at CEO Rick Wurster's comments, the net flows into Schwab Wealth Advisory specifically increased by 80% year over year. There's a massive spike in clients actively asking for professional, fee-based management.
It really reveals a profound psychological shift in the retail investor base. You have this massive influx of core net new assets, $120 billion in the quarter. But the clients bringing that money in are clearly looking for a human safety net.
They don't want to go it alone.
Exactly. Fee-based managed investing solutions saw their average client assets reach over $763 billion.
So we have this massive migration toward like a do-it-for-me wealth advisory mindset. But here is the paradox that I found fascinating in the data.
Oh, yeah.
On one side of the platform, clients are handing over the keys and saying, please manage this for me. But on the exact same platform, the active, aggressive, do-it-yourself trading metrics are surging just as hard.
The duality of the retail market right now is just striking.
It really is. I mean, the platform handled a record 11.9 million daily average trades.
Almost 12 million a day.
Yeah, that is a 57% increase compared to last year. 11.9 million times a day, someone is pulling the trigger on a trade.
Yeah.
And it's not just cash trading. Here's where it gets really interesting. Margin loan balances jumped 30% quarter over quarter,
Which is a huge spike.
hitting $165.1 billion by the end of June.
Yeah, that margin loan figure is critical to unpack. For context, trading on margin means an investor is borrowing cash directly from Schwab, using their existing portfolio as collateral to buy even more stock.
It amplifies your upside gains.
Right, but it identically amplifies your downside losses.
It's pure leverage.
Yeah.
So if margin loans are rocketing up 30% in a single quarter to $165 billion, that tells me retail investors aren't just participating, they are levering up. They are aggressively confident.
Very confident.
But as an analyst, does a 30% spike in leverage across a retail base signal supreme market health? Or is it a flashing red indicator of systemic overleverage?
It's a behavioral indicator of high risk tolerance, certainly. When you combine a 57% spike in daily average trades with a $165 billion margin balance, you are looking at a highly engaged, highly aggressive retail cohort.
So not quite systemic risk yet.
Right. As for whether it's a systemic red flag, the risk is mostly contained at the individual portfolio level. That's because Schwab's own capital structuring is designed to absorb those margin fluctuations.
Got it.
But strategically, what Schwab is doing with this active cohort is brilliant. They aren't just letting them trade the same old equities, they are actively feeding this engagement by deploying new technology.
Yeah, that stood out to me as well. They announced 2 major rollouts in Q2. First, Schwab Crypto,
Right.
which gives retail clients direct access to trade Bitcoin and Ethereum right on the platform. And second, they launched something called Portfolio Insights,
which is very new.
Yeah, they explicitly describe it as a generative AI-powered capability to help investors analyze their portfolio performance.
Those two features, honestly, are the missing puzzle pieces that explain the 11.9 million daily trades. By rolling out direct crypto access and native generative AI, Schwab is fundamentally changing its competitive positioning against disruptive fintechs.
They're essentially building an Apple-style walled garden, right?
Exactly.
Because historically, if I'm an aggressive younger trader, I might keep my boring IRA at Schwab, but I'd open an account at some flashy fintech startup to trade Ethereum or get AI analytics.
Sure, you'd split your assets.
But by bringing crypto and Gen AI in-house, Schwab is making the friction to leave incredibly high. You already have everything under one roof.
That is the exact strategy. The switching costs become enormous. They are eliminating the need for that highly engaged, high-margin user to ever leave their ecosystem.
And the Gen AI tool portfolio insights is particularly clever. The fine print in the release notes that it generates a narrative snapshot of your day change performance.
Oh, nice.
It recaps news specifically affecting the top S&P 500 movers in your personal portfolio, and it curates expert content. It's like giving every single retail trader their own personalized financial analyst.
Which deepens the client relationship immensely. When your interface provides AI-driven bespoke analysis, it drives daily logins.
Right.
High login frequency drives trading volume, and trading volume drives margin utilization. It's a self-reinforcing loop. This is how you sustain a platform that processes nearly 12 million trades a day, while simultaneously growing traditional, sleepy wealth management flows by 80%.
They are just servicing both extremes of the market perfectly.
Exactly.
Okay, so the revenue engine is highly diversified and humming at $7.1 billion. They are successfully monetizing idle cash, they are capturing wealth management fees, and they are keeping the aggressive traders locked in with crypto and AI.
A very healthy top line.
But generating revenue is only one half of the income statement. What does it actually cost to run a machine that touches $13 trillion? Because this brings us to the bottom line and a concept I want to dig into: operating leverage.
Right. This is where CFO Mike Verdeschi and the management team really prove the efficiency of their model because, you can have all the revenue in the world, but if your expenses scale at the exact same rate, your profitability stagnates.
And Schwab's profitability is definitely not stagnating.
Yeah.
The report notes their adjusted pre-tax profit margin reached an incredibly impressive 54.3%.
Which is massive.
That is up from 50.1% the previous year. To give you, the listener, some context, you usually only see 54% profit margins in pure software-as-a-service companies, not in heavily regulated financial institutions. How are they extracting a 54.3% margin?
Well, if we connect this to the bigger picture, it comes down to operating leverage acting as a wedge between revenue and expenses.
Okay.
Operating leverage occurs when a business can grow its top-line revenue at a much faster rate than its fixed and variable costs. Let's look at Schwab's specific numbers here. We know they grew total net revenues by 21% year over year.
Right, from the headline numbers.
But if you look at their adjusted total expenses, they only increased by 11%.
So their revenue is growing at roughly double the speed of their operating costs.
Precisely. Let's break down where that 11% expense growth is actually going. Their largest expense line item is compensation and benefits, which hit $1.79 billion.
They have a lot of salaries.
It was up 17%, which makes sense. They're investing heavily in tech talent for things like that Gen AI rollout. But their other overhead things like professional services, occupancy, and equipment remained relatively flat.
So because the tech infrastructure to manage $10 trillion is fundamentally the same infrastructure needed to manage $13 trillion, every new dollar of revenue doesn't require a new dollar of expense.
Exactly.
When the top line grows 21% and expenses only grow 11%, all that excess capital cascades straight down the income statement.
That is the wedge. That is how you drive an adjusted pre-tax margin to 54.3% and generate $2.9 billion in adjusted net income in a single quarter.
And they're taking a massive chunk of that $2.9 billion in profit and returning it straight to the shareholders. During the quarter, they repurchased 11.2 million shares of their own common stock for $1.0 billion.
$1 billion just on buybacks.
Furthermore, they redeemed $2.1 billion in Series I preferred stock. So what does this all mean? As an analyst, how should we interpret this capital allocation strategy? They have retail clients leveraging up to $165 billion in margin loans, yet the firm is casually dropping $1 billion on buybacks.
It tells you that management views their balance sheet as an absolute fortress, and the regulatory metrics back them up. The report highlights their preliminary adjusted Tier 1 leverage equaled 6.8%.
Okay, for the listener who doesn't spend their weekends reading bank regulations, what exactly does an adjusted Tier 1 leverage ratio of 6.8% measure, and why does it matter?
Think of Tier 1 leverage as the ultimate financial shock absorber. It measures a firm's core equity capital and its purest, most liquid net worth against its total assets, including all those margin loans we talked about.
Okay.
A 6.8% ratio is incredibly robust. It proves to regulators and to investors that Schwab has more than enough pure cash on hand to absorb massive, unexpected market shocks without breaking a sweat.
So because that shock absorber is so thick, they have the regulatory blessing and the financial confidence to safely facilitate $165 billion in risky client margin loans while simultaneously taking $1 billion of pure operating profit and using it to buy back their own stock, which mathematically reduces the number of shares on the market and makes every remaining share held by an investor more valuable.
It's the ultimate flex of a mature, diversified business model. They are generating so much cash from their net interest spread and their wealth fees that they can fund aggressive tech expansions while still returning billions to shareholders.
Which brings us to the core takeaway for you, the listener. The reason we wanted to dive deep into these consolidated financial statements today is because Charles Schwab's Q2 2026 report is the perfect blueprint of how modern financial titans actually operate.
They really aren't just one thing anymore.
No, they aren't. They are quietly making billions off the 3% spread on your uninvested sweep cash. At the same time, they are earning billions in fee revenue from older demographics asking for professional wealth management.
Right.
And simultaneously, they're facilitating nearly 12 million active trades a day, funding $165 billion in margin leverage, and rolling out direct Bitcoin access to keep the younger demographic locked in.
And that leads to a final thought I think we should leave everyone to mull over. We look at this earnings report and we see a $13 trillion legacy firm. You know, a pillar of traditional buttoned-up finance.
Sure, Granddaddy Schwab.
But look at their actual strategic execution. They are rolling out direct Ethereum trading. They are deploying proprietary generative AI natively into the retail user interface. They are operating at a 54% profit margin because their digital scale allows revenue growth to outpace expense growth 2 to 1.
Those are the metrics of a tech monopoly, not a traditional bank.
Exactly. The line between traditional Wall Street banking and disruptive Silicon Valley fintech is rapidly disappearing. We are entering an era where your legacy wealth broker is effectively just a massive, highly regulated tech company disguised as a bank.
When the old guard adopts all the weapons of the disruptors, the entire competitive landscape shifts. And the data in this Q2 report proves that shift is already complete. Thank you for joining us on this deep dive into the underlying mechanics of the market. If you want to keep peeling back the layers on how the financial world actually works, make sure to follow the show for a continuing coverage of earnings season. We'll catch you on the next one.